Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Apple's stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Apple generates more than half its revenue from the iPhone. It also sells computers, tablets, Beats headphones, AirPods, etc. In addition to selling physical products, it offers services such as selling advertising space, Apple Care, cloud computing, etc. It is the most valuable company in the world. It has the highest market cap, and it's bigger than any other private company. Saudi Aramco used to be bigger, but now Apple's bigger. They are the second largest company in the world in terms of revenue. Walmart is number one. The company is headquartered in Cupertino, California, was founded in 1976. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Zicha, Vienna, Euro, TLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Ukraine, Colombia, Santiago, Kazakhstan, Lima, and Neo Stock Exchange. Let's get started with the model. This is a large cap company, 2.6 trillion market cap. They're trading at $165 a share, and they have 16 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a mind-boggling $111 billion of free cash flow in 2022. That did drop to $97 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's almost $100 billion in 2022, $95 billion in the trailing 12 months. Revenue is the sales for the company, and that grew from $275 billion to $388 billion. It did peak in 2022 to $394 billion. This is their income statement. The top line is the revenue, the sales. Their revenue for the accounting year 2022 is $394 billion. Their accounting year ends in September. Most companies, it ends in December. Let's dig deeper into this $394 billion so we know what it is. This is their revenue from their 10K, 2020, 2021, and 2022. So iPhones is more than half their revenue, $205 billion. They generated $40 billion from selling the Mac computer. iPads is $29 billion. Then you have wearables, that's $41 billion. This category includes AirPods, Apple TV, Apple Watch, Beats products, etc. Then you have services, that's $78 billion. That's a pretty big chunk of their revenue, about 20%. Services are advertising space, Apple Care, cloud computing, digital content, etc. A little less than half their revenue is in the Americas. That includes South America and North America. Then Europe is $95 billion, China $74 billion, Japan $26 billion, and the rest of the world $29 billion. When you compare 22 to 21, it goes up in every country except Japan. Japan did decrease. It was $28 billion, now it's $26 billion. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. An example are all the expenses to make the iPhone. Revenue minus cost of revenue gives you your gross profit, and that is down from 2022. It's $167 billion in the trailing 12 months. Then below that is their operating expenses. These are all the expenses not directly related to generating the revenue. An example is marketing. Gross profit minus operating expenses give you your operating income. That's also down from 2022 from $119 billion to $114 billion, but up a lot compared to 2020 of $66 billion. They received $3 billion of interest on their investments. They paid $3.2 billion of interest on their debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is down a bit from 2022, up a little from 2021, up a lot from 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is on your income statement. That's your accounting profit or loss. It's not actual cash. So it's just amazing a company can generate over $100 billion of operating cash flow. They do spend about $10 or $11 billion a year in CapEx. These are investments in property, plant, and equipment. When they need to build a new factory to start making more phones and computers, the cost of that factory goes into CapEx. Operating cash flow minus CapEx gives you your free cash flow. That's down from 2022 at the highest of $111 billion. It's $97 billion in the trailing 12 months. They did pay off a lot of debt in the trailing 12 months, $18 billion. They added about $12 billion in 2021, $20 billion minus $8.8 billion, and they added about $4 billion in 2020. The company does pay a small dividend, but the way they really reward shareholders is buying back stock. They buy back tons of stock, $72 billion in 2020, $86 billion in 2021, and $89 billion in 2022. When a company buys back its own common stock, that decreases the shares outstanding. It makes your shares more valuable. Let's look at their capital structure. $56 billion of equity, $111 billion of debt. They're 34% equity, 66% debt. They do have lots of debt, but they can pay off a big chunk of their debt with the cash in their balance sheet. If they used all the cash in their balance sheet to pay down their debt, they would only have $60 billion of debt left over. I gave them the lowest whack on Finbox, 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 trillion. We divide that by 16 billion shares. And we get a calculated stock price of 108. They're trading at 165, so they're trading at a 52% premium. It's a sell according to the model. 13 analysts forecasted their revenue for 2025, and their forecast is $445 billion. For 2024, it's $417 billion. And for 2023, it's $389 billion. I continue this trend into 2026, and I got $473 billion. That's how I got their future revenue estimates. They convert on average 26% of their revenue into free cash flow. So I multiplied their future revenue estimates by 26%. That's how I got their future free cash flows. The website Simply Wall Street's valuation is 120. They're saying it's 38% overvalued. 31 analysts priced this stock, and the average price target is 170. The low is 107, the high is 210. Another 42 analysts priced this stock, and the average price target is 168. They're saying it's 16% undervalued. This is where the stock has been trading the last 5 years. This is one of the few stocks that really hasn't gone down in price. Even with all the tech stocks really crashing the past 18 months, this stock has done pretty well. It's almost trading at its all-time high. If you invested in this stock 5 years ago, you'd be up 290%. The S&P 500 and Berkshire Hathaway is up about 55% in that same time frame. I wish I just put all my money to Apple, but I guess hindsight is 2020. They have a beta of 1.3, so the stock moves a little more than the market. It's down 8% in the past 52 weeks, while the S&P is down 10%. The 52-week low is 124, the high is 178. And the stock is trading above its 50-day and 200-day moving average. This is still a really popular stock. Well over 60 million shares are traded each day. Pretty much all the shares outstanding are on float. 61% are held by institutions. 2/3 of 1% of the shares are shorted. They raise their dividend each year. It was 18 cents in 2018. It's up to 23 cents a share. Their yield is about 1/2 of 1%, which is 15% of their free cash flow, 15% of their net income. This is their dividend yield the past 10 years. Their yield was close to 3% in 2013. The forecast is for their yield to be 0.7% by 2025. The company has done 5 stock splits, a 2-for-1 way back in '87, a 2-for-1 in 2000, a 2-for-1 in 2005, a 7-for-1 in 2014, and a 4-for-1 in 2020. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $125,000 today. You'd be really happy at 29% annual return. The CEO, Tim Cook, makes a pretty penny. Annual salary of $3 million, total compensation package of $99 million. There's only been one insider trade the past 12 months, a sell of 20,000 shares by Chris Kondo. Half the companies held by institutions, 40% by the general public, 6% by public companies, 0.06% by insiders, 0.04% by the government, and 0.002% by private companies. They employ lots of people and it goes up every single year. They're currently at 164,000 workers. The biggest shareholder is Vanguard at 8%, BlackRock at 6.5%, Berkshire Hathaway at 5.7%, State Street at 3.7%, and Fidelity at almost 2%. The best way to look at ratios is to compare them to companies in the same industry. There are 16 companies in the same industry as Apple, and if Apple has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend lots in CapEx, $11.7 billion. They don't have such a good debt to equity ratio. For every dollar of equity, they have $2 of debt. They do pay a dividend. Most companies on this list do not pay a dividend. They generate a lot of free cash flow, $97 billion. They're the biggest company in the world, 2.6 trillion market cap, a lot bigger than the other 15 companies combined. They have a really high price to book. They have a pretty weak balance sheet. Their PE, price to free cash flow and price to sales, aren't that great, but they are better than average. They generate tons of revenue. They're growing at a 10% clip, which is pretty good for their size, but a lot smaller percentage than it used to be. And they have a good ROA and ROE. So to summarize, I have them trading at a 52% premium, and this is such a great company, but I really think it's about time the stock comes down. I think it's been overvalued for a little bit now. I'm probably going to start shorting it this month. I hope I don't lose too much money. I ranked their free cash flows and revenue 8 out of 10. Their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.